Hello, this is Senator Katie Fry Hester, and you are listening to the Conduit Street Podcast, the official podcast of the Maryland Association of Counties and your best source for Maryland politics and policy.
Welcome to the briefing room here on the Conduit Street Podcast. I'm Don Butchko, and joining me once again in the co-host spot is Terry Hickey, Director of Baltimore County's Department of Housing and Community Development. Terry, I feel like this is going to be our best episode yet.
I got a feeling, Dom. It's looking that way, but I'm great to be back. Super excited, dive into a topic that's usually buried deep in the fine print of a development pro forma. More vocabulary that we're going to put in our glossary. Development pro forma. But this is absolutely critical for understanding how affordable housing actually gets built. So before we get started, how about a quick recap of our last episode because it was so awesome.
It sounds good. If you did not go back and listen to that, you have to because that was a real banger. We had a really insightful conversation from Maryland Department of Housing and Community Development Secretary Jake Day. He walked us through the finer points of public financing and the various programs offered by the department. If you have not caught that episode, I will say I'm deep in the housing space and I learned a lot. Plus, Jake is just a cool guy to have on the pod. So go back and take a listen.
So I know all this housing lingo. I'm going to go back and look up real banger, but I think it sounds like you mean that was a really good episode. So I'm going to go with it. If you've been listening, you know that what we're trying to do here is break down the complicated world of housing finance piece by piece so that everybody can kind of understand it from their own perspective. So today we're going to focus in on the part of the capital stack. We've been talking about that stack for several episodes that often gets the least amount of attention but can make or break a deal, which would be private financing. So to help us unpack all of this, we've brought in somebody who lives and breathes these transactions every day. So let's get to our guest, Dom.
Yeah, so we have brought in like the real OG money daddies. We are joined by Jordan Bishop from JPMorganChase. Jordan, welcome to the briefing room.
Thanks for having me.
So Jordan, kind of before we dig in, I love to ask our guests, tell us about yourself. How did you end up at JPMorganChase? How did you end up in the thrilling world of housing finance?
Here, it's a fair question. I actually grew up in Maryland, so I have some Homer bias to why we like to do business here. But I went to school down in Louisiana, and I studied finance, and I moved back to the D.C. area when I graduated. I would argue that because of the headquarters of Fannie and Freddie being here, there's a disproportionate number of multifamily finance kind of companies that have operations in the D.C. area. And so wanting to start my finance career, I kind of gravitated towards multifamily financing, which started on the debt side. Then I went to work for a real estate developer doing affordable housing in DC. I started a consulting firm for a long time. I've kind of come full circle now back on the lending side here at JP Morgan.
That's awesome. Well, thanks for being here. It's good to get to know you a little better, Jordan. And I think, Dom led off by saying for this podcast, our primary listeners are typically state and county policymakers. And they are all across the board as far as their background in housing finance. Some really dig into this and some, it's just a daunting subject. So let's start at a really high level. When we say private financing in an affordable housing capital stack, what are we actually talking about? What role does private capital play alongside the things we've been talking about so far in this pod, like tax credits and local government subsidies? Help us bring it all together?
Sure. So the Low Income Housing Tax Credit Program, which was signed into law 1986 when I was 3 years old, is by far kind of the biggest, most robust, successful affordable housing production program we have nationally. But it's really, really difficult to go pay your contractor who's painting your fence or installing a drywall in federal tax credit. That guy probably wants to collect cash in the form of a check or a wire transfer. And so in order to kind of convert tax credits into cash so you can actually pay the cost of the sticks and bricks and the labor hours that actually produce housing, private finance is involved. So tax credits only have value if you have a tax liability. Very large financial institutions like mine are relatively confident in forecasting our tax liability over the next 20 years. So there's a robust market to buy these tax credits. And when we buy the tax credits, the cash from that sale can be used to build affordable housing. And it can be combined with, like you mentioned, public sources. which can be cash or other kind of incentives that the government might offer, like a tax abatement, but also private capital from the debt market. And so that's what I do on my team up and down the East Coast. We lend probably about $1 or $2 billion a year in terms of debt financing. That's combined with the equity raised from tax credits, and it's combined with the state and local subsidies to kind of fill out a capital stack for a deal. And I'm happy to go into an example if you'd like.
I'm interested in hearing more about that because, when you say you go onto the debt market, is that JPMorganChase kind of like reaching down into, their money, or are you connecting investors with projects?
Excellent question. A little bit of both. So we do a ton of lending from our balance sheet. We also have relationships and licenses to land Fannie and Freddie kind of forward commitments for amortizing perm debt. And then there's other institutional capitals where we would almost serve as, like you said, as an intermediary. The vast majority of what I do at the bank is use our balance sheet to originate and close construction loans to affordable housing developers.
No, well, that's why it's so complicated. And you've got folks on the county government side who are working on the public subsidy and in the housing space here may not have ever really interacted with the private equity side. So I think there's a lot for my colleagues and me to understand as well. But Jordan, if you've got an actual example you can walk us through, I think that's probably a good way to go.
Sure. So I think there's a lot of benefits to kind of bringing private capital to the table to kind of solve a social good or social problem, being the lack of, quality affordable housing. One of the benefits is that it allows the state and the county and the city to kind of leverage their dollars. And so we recently closed a transaction in Baltimore. It's going to be one phase of this project is a $90 million building. So it'll be 150 new apartments at various income levels. But the developer on that project went and assembled a bunch of kind of subsidies from, like I said, the county and the city and the state, but they only fund about a third of the project cost. So maybe $30 million they assembled from a bunch of government sources. The other $60 million comes in the form of private capital. So for that like $1 that the government's invested, they've got $3 of kind of housing production.
Really basic question that I don't know if everyone thinks about, but how does this normally work, Jordan, in sequencing, right? So is it typical that affordable developer is going to line up their private funding sources and then come to us? Or are they talking to us and going back and talking to you and your colleagues about filling a gap? Or is it kind of based on the deal?
Yeah, it's an excellent question. At the end of the day, to close the deal, all the trains kind of have to run in the station at the same time. But just at the very outset, when a developer's like starting to assemble an application to go and request an allocation of subsidies, be it tax credits or tax exempt bonds or cash subsidies or tax abatements or vouchers, what have you, they're very likely, as part of that submission that they're going to send to Maryland CDA, as an example, they're going to want to include or be required to include some letters from private capital sources like myself to show, okay, well, here's a $90 million project. JP Morgan, based on this set of assumptions, is willing to, invest $30 million of construction debt, or, another entity is willing to buy the tax credit stream from this deal, and that will generate $30 million of cash. And getting those kind of letters to show indication and interest from financial institutions is very frequently part of the application package that developers would submit to the county or the state.
Let's get concrete for a second, because our folks who are listening to this, they're mostly policymakers. They're really not in the development space. So let's say I'm a developer. I want to build a 100-unit affordable housing community. They walk into your office. What's the first thing that you look for to determine whether JP Morgan wants to participate in this deal? Can you just kind of walk us through from the developer and from the bank side what that looks like?
Sure, absolutely. So my job as kind of a originator, as I kind of play offense as a salesperson for the bank, so I'm supposed to go out and kind of bring these opportunities to the bank. But I'm not going to get anything done unless I can get my projects and my customers through credit committee and through the folks at the bank that are paid to manage the risk and look at the downside and the worst case. So I kind of have to put on my credit analysis hat when those folks walk in and say, okay, what are my credit officers going to want to know before they approve lending this group, $50 million or what have you to build their $100 million project? So I'm going to ask about their whole set of assumptions, both kind of their project budget and their operating budget. What other sources are they thinking about? How realistic are all of the figures in those calculations? And we can vet that because we have a ton of data. And I work with a really, really smart group of professionals like myself that have closed dozens and dozens and dozens of these deals over the last decades. So we kind of know what questions to ask and what looks realistic. Then we also want to assess the sponsor and their capacity. What evidence is there that I can tell my credit officers that this group or this person has assembled a team that has the qualifications and experience necessary to execute and also to solve problems when they inevitably come up?
So let me follow. I'm following you, and I don't think that's a part of this. I think a lot of folks just take for granted when they're looking at the 202 on the local side, the pro forma.
Mm-hmm.
They've already got this lined up, and we just make assumptions that it just was easy and there you go. But I think from your end, there's the credit side, there's the risk tolerance that you just talked about. Does the private capital industry tend to provide better terms on affordable deals? Do they see them as better long-term investment vehicles? Or do you treat these sort of on the interest rate and other term side just like a regular market rate deal?
Yeah, it's a good question. I think if you pull like a robust data set, you're going to find that some published, academic studies have shown that low-income housing tax credit deals tend to default a lot less often than market rate deals for a variety of reasons. I think one, you're kind of like not really competing with market on price. You're offering a below market rent, so you have kind of a leg up to keep the building full of folks. It's also like less difficult for folks to pay rent that are lower. So you're a little less exposed to market volatility in terms of like new buildings coming online and relying on really aggressive rent growth. But certainly not least, though, is that every single deal that's, has to assemble all these different capital stacks, come to the private market for debt, go out to the private market for equity, go to the city, go to the county. Those deals are getting underwritten and scrutinized by a lot of different folks in a lot of different places. And so by the time those deals close and go into production, they've really been through the ringer, assessed a lot of risks by a lot of experienced professionals. And I think that kind of results in a lower default rate. And so we probably are a little bit for maybe more advantageous terms to a low-income housing project than we would to a market rate project. But I don't work on the market rate side, so I can't really speak to exactly how much risk we're willing to take on that side.
So, Jordan, I have kind of a little bit of a wild question here. So housing has been really big in Annapolis and at the local level for years now. Like every year, we're just seeing more and more housing-related bills. A lot of them are focused on the land use side and the regulatory side, but there's not as much on the finance side. And that's something that we're seeing a lot more attention drawn to. That's why Terry and I are doing this whole podcast series on housing finance. Can you try to connect for a minute the finance and the regulatory policy side? Because a lot of folks who are listening to this, they pass legislation, they create regulations, they say, what areas can be zoned for what use, et cetera. But there's not a lot of connection between, okay, this is the rules of how you play, but how does that connect to the dollar and cents that actually buys the sticks and bricks? By the way, love that phrase, gonna steal it. But can you kind of draw that through line between, when you guys are evaluating a project, how you look at local jurisdictions process stuff or what regs they have, et cetera?
Sure. So I'd say that in general, it's really helpful when jurisdictions have a kind of a predictable funding cycle with kind of predictable like scoring metrics that are easy to understand and more objective rather than subjective. So I actually think the state of Maryland's done a really great job on that front. I think the state actually has 2 funding rounds this year in 2026 versus a lot of places, there's just one annual round. So if your project's not ready by the deadline for that one annual round, you might have to wait another 11 months to apply for subsidies. So I think Maryland's doing a great job there as well. Really just like staying open and listening to feedback from the capital markets and understanding, what my risk officers care about, what we're willing to fund, what bridges we're not willing to cross, and just kind of evolving, but in response to feedback from my customers who are housing providers and developers. I think that being transparent is also helpful. Like I said, the folks that are going in to kind of compete for their scarce resources on an application basis, to the extent they can kind of plan for how their project is going to score ahead of time, and then see after when the state kind of collects all the applications and score them, how they scored everybody, why they scored them the way they did. I think that really helps developers kind of plan their pipeline because it's a really capital intensive business. And developers have to risk a lot of money on the front end before they even know if they have an award of subsidies. So the more kind of transparency that government actors can bring, the more clear the objectives are. I think that helps everybody involved.
So this might seem like a no-brainer, but to kind of tie a bow on it for, again, our policymakers listening, the private sector likes predictability. And so if you're a jurisdiction that wants to prioritize housing, predictability.
Yeah, I think that's right. Like I said, the timeline here to design a project and go and apply for subsidies, go and attract capital, then go actually build the project and lease it up to income qualified households. We're talking about a several year horizon. So the more predictability the government can add to those processes and, what it takes to have a successful application for this type of subsidy, this other type of subsidy, and explain the kind of thought process and how the resources are allocated and when the timelines, like sticking to the timelines, I think is really helpful too.
Well, just to play that out a little bit also, I think I'm starting to see in our jurisdiction and others, more counties that due to the scarcity of state and federal subsidy money and just gaps in LIHTC projects and volatility all across the board, trying to do more deals with developers, particularly on the acquisition and renovation side, just between the county, the developer, and then the private market, right? Mm-hmm. So I would say if we're trying to do one of those deals and maybe throw in tax benefits to the deal as well, on your end, that predictability is going to be even more important when there isn't that LIHTC subsidy in the mix.
Yeah, I think that just you hit the nail on the head. I mean, the cost of new construction has kind of accelerated faster than I think like the pots of money that are available to fund it, especially to fill gaps. And so I think there are, in Maryland and other jurisdictions outside Maryland as well, are kind of taking a really hard look at getting more bang for their buck by doing preservation rehab, just because it's just more cost effective.
Got it. So let's go from there to, we were speaking with Brian McLaughlin, who serves on the Richmond Fed board and has been in the housing space for a very long time. And he raised the issue that it wasn't uncommon for an affordable deal to contain, I don't know, Dom, like 20 plus layers of financing.
A Smith Island cake of financing.
Well, and I was going to go there and say, I've been at conferences lately where they're talking about the stack of pancakes, but I think our own comptroller, who we're going to be talking about in a later episode, coined the term Smith Island cake, which I think is perfect yet frustrating all at the same time. So you've got all these layers, Jordan. I think a lot of people assume all of those layers are on the public side, but how many, you've referenced this a little bit before, but how many private funding sources could be in that Smith Island cake at any one time? And is that good or is that concerning?
That's a good question. Yeah, no, he's not wrong. I've definitely seen deals with 20 different sources of funding. I think you can kind of bucket them all into a couple different broad categories. What I do here is I do senior mortgages from obviously private capital. Those are going to be combined with equity that's raised by selling tax credits. That's also, technically private capital. Purchasing that benefit stream and converting it to cash to build the project. There'll be subordinate debt sources. A lot of times those will come from the municipalities, from the city, the state, the county, but not always. There's also kind of private sources that like CDFIs that might be able to provide some subordinate debt financing that could be cash flow contingent in theory. There's also grants from philanthropic sources. I think, from a very high policy level, those are hard to rely on because they're, allocated by private foundations who, might choose to do a lot of business in Maryland one year and not much the other. But that's just another source of private funding that goes into deals. If you want to get really wonky, a lot of tax credit deals, the reason a tax credit investor is kind of buying the benefit stream is because they want tax losses and credits to offset tax liability. So a lot of times a grant that will go to one of these projects, because that would create taxable income, that goes directly to a nonprofit and then provides a subordinate loan to a project to avoid kind of creating taxable income to the partnership.
All of these things you're saying just sparked a question in my head. I think another thing that we make assumptions on, but developers come in all shapes and sizes. There's small nonprofit developers, giant nonprofit developers, and then the market rate folks that are getting involved in affordable deals. It seems like there's a lot of work on the developer side to go out and investigate all of these different potential private sources and package them together. And I imagine all developers are not created equal. on that front. And the ones that are better at, I guess, bird dogging are going to have better stacks, right? And be more competitive. I mean, is that true or doesn't it work that way?
Yeah, no, I think you're right. I think that that's one of the challenges of being an affordable developer is getting really familiar with the really complicated, convoluted capital stack. But, we do a ton of deals nationwide. We probably close 120 a year or so in my group, just on the construction debt side. So there's folks that are out there doing it. They're doing it successfully. I'm sure there's plenty of ways that they would advocate to make that assembly process a little cleaner, but they've got to do what they got to do to fill gaps. And I'm glad that they're able to find success in that endeavor.
I'm going to jump in here. So first, I've just never heard of the term bird dogging. I just had to Google it. So it derives from hunting dogs, which is really cool when they would, go and find the ducks.
Did I get it right?
Yeah. So it means to track, watch closely, or investigate someone or something. I've just never heard the term. So if you were born in the 90s or later, yeah, we'll add it to the glossary. Jordan, so we've talked a lot. The conversation we had with Brian McLaughlin was really good. And so I'm curious of your thoughts on this one. When we're talking about the capital stack and everything that goes into it, it really sounds like, at least on the affordable side, you're not going to have an affordable project that doesn't have some sort of subsidy, whether it's from nonprofit or the government. There's kind of no such thing as naturally occurring, at least new affordable housing, because someone has to come in and kind of put their thumb on the scale. Otherwise, it'll all be market rate. And depending on the market, that's just going to naturally be not affordable to most folks. I mean, how do you respond to that observation? Am I totally off?
No, I think you're spot on. I think that, again, going back to the sticks and bricks, they actually cost, lumber. A stick doesn't know if it's going into an affordable project or a market rate project. So it costs the exact same amount, right? And it's same as all the commodities that go into that. Also, the labor rates that you're paying to the folks who are actually swinging the hammers, probably the exact same, if not, across projects. And so you're exactly right. Absent a big basket of government subsidies that kind of give kind of carrots and sticks to create rent and income restricted housing, developers without that are going to, want to assemble, they're going to need to assemble 100% private capital. All of that capital is going to want to return, whether it's debt or equity, and they're going to want upside if they're taking real serious equity risk. So you're exactly right. I think that the vast majority, it'd be very, very odd to see new construction project be rent and income restricted without any kind of government involvement whatsoever.
I'm taking notes as I go, and I'm going to start stealing all of our guests' cool, thoughtful saying. So the stick doesn't know whether it's going into affordable or market, I think is awesome. I'm going to start saying
that was good. That was really good.
But it does raise a question, Jordan, and you may or may not have experience with this, but I am also hearing, particularly with some of these large national or global companies that are playing around in the modular or manufactured housing space, where they actually are, Dom, trying to find ways through AI building managers and all sorts of stuff, ways to just make housing so much less expensive to build and manage that they are actually trying to create naturally occurring new housing. And I'm wondering, Jordan, if those folks that are having those conversations, are they starting to come to the JPMorgans of the world to attract investment in that without all of this government subsidy that, while it's necessary, I think we all have to agree, it does add a lot of cost overall to the per unit on these deals. So are you seeing any of this as a trend, or is it still kind of perspective?
Yeah, I mean, I'm looking at a modular deal now, and some of my colleagues have funded modular projects. I mean, the vast majority of what we do here in my role are projects that do have government subsidies. I think that it's great if people are going out and trying to find ways to reduce costs of production. That's all power to them. But without kind of the government telling them or restricting what they can lease those units for, you and we as kind of citizens are just relying on their benevolence. They've found a way to reduce costs. They promise they're going to keep rents really low for the goodness of their heart. That's great. I don't know that that's an effective, scalable solution. I think that folks that will find ways to reduce construction costs, more often than not, those private market individuals who are taking risk on the transaction are going to take as much upside as people are willing to pay in terms of housing costs.
So Dom, before I turn it back to you, I just want to cement that point. I think that is so important. If you're a local housing official and you are struggling with, you don't have a lot of local subsidy to put into the deal, you don't have a lot of flexibility, and you have a developer come from nowhere and say, I've got this inexpensive solution that'll be naturally occurring, like low market rate, just trust me, help us out, maybe even donate county land to do this, trust us down the road. I think Jordan's comments are really spot on. You've got to get it in writing. You've got to have those declarations. You've got to have something that preserves that affordability. What is it? Trust now, but verify. Is that the? We're throwing all the sayings out today.
That's an old presidential phrase that a lot of lenders, took to heart. Trust but verify.
All right. So, Jordan, you've been an awesome guest. One last question for you. So we have a lot of folks who really make decisions, the movers and shakers listening to this podcast, whether they're at the state or the local level. So they are listening. You have their ear for a few more minutes. What is the one thing that you want them to walk away with, especially from, the private sector investment side when it comes to housing finance? What should these elected officials know?
Well, one, if we're talking to Maryland officials, I'd say keep up the good work. They have a lot to be proud of in terms of how they've kind of supported the affordable housing landscape through a variety of initiatives, not just dollars and cents. So that's one. Two, you mentioned earlier kind of like the constraints around housing supply. It's not really something that is in my purview, but I am a firm believer in the forces of supply and demand. So anything that can be done on a zoning front to increase supply is very likely going to have a positive impact on the folks that are having a hard time affording housing. Last but not least, there's always talk of regulatory reform. I think just keep in mind that every new regulation you add or every reform that you make can increase barriers to housing production or it can decrease barriers to housing production. So just kind of keep that in mind when you're creating new regulation.
That is a great place to leave it. Jordan, thank you again for coming on the briefing room.
No, this has been great. Yeah, this has been great.
All right, let me read us out. Remember to like and subscribe wherever you listen to podcasts. Not enough of you are subscribed. Terry and I are up at night crying. Please like and subscribe. Register now for the annual Mako Summer Conference, August 12th through the 15th in Ocean City, Maryland. And thank you, everyone, for listening to The Briefing Room here on the Conduit Street Podcast.